Welcome to the Value Creation class. My name is Luis Senra and I'm the head of Peloton Private Equity Advisory. How to be more valuable? How to create company value? Of course, this is the most important question that company directors and company officers try to answer every day. We have tons of research about this topic, and years would not be enough to tell you everything that we know and everything that we don't know about it. But in this class, I will try to share with you some basic concepts that private equity use to create company value. This class is divided into three main parts: fundamentals of value creation, value strategies, and value creation process. We will briefly discuss the most important topics that you need to know to understand how private equity firms create value. Those are the same strategies that we at Peloton Private Equity Advisory use to help companies to improve their value and shareholders' return. It is common to think that improving operations and making the company more profitable is the only way to create value. But making the company more profitable is just one of several strategies that we have to improve company value. More profit is not the only way. As investors, private equity focuses on return on investment and not only on company profitability. Value creation is a capital allocation problem. Value is created by compounding capital at a rate greater than its cost of capital. What makes a private equity return better than an investment fund is that owning companies allow them to access better investment opportunities. Owning companies creates unique high return investment opportunities not available to the public market. The private equity job is to identify high return investment opportunities inside each potential and current portfolio company. Remember, identifying the best investment opportunity and allocating capital is what drives private equity thinking. The first basic concept for private equity is that value is the excess. To create value, every investment must return more than its cost of capital. This is interesting because the most common private equity fee structure establishes that the private equity will profit only from the excess of value, the value that exceeds the investor opportunity cost. If any investment return is lower than its cost of capital, this investment destroys value, even if its return is positive. A company is an investment, so to create value, every company must create a return in excess of its cost of invested capital. Value is the excess of return. This is why private equity will focus on creating the best real return on investment possible. Real ROI is free cash flow minus the cost of invested capital divided by invested capital. Remember, value is created when you improve the real return on investment. The second basic concept for private equity is that a company is a collection of systems that creates cash flow. From this perspective, every company is a portfolio of investment opportunities, and each one of them represents a potential high return investment opportunity. Private equity is looking for a high return investment opportunity. Subdividing a company into several different cash systems enables the private equity to identify which cash systems are the value creators. Of course, subdividing a company into divisions or business units is not uncommon for companies, but private equity will do it in a much deeper way. For example, if a company has 4 or 5 business units, the private equity will subdivide the same company into hundreds of cash systems. Private equity has 2 tools to improve the portfolio value: reinvest and reallocate. They can reinvest the company's free cash flow on the cash systems with the highest real ROI, and they can reallocate the capital from the cash systems with low real ROI into the cash systems with high real ROI. As a company owner, private equity has one additional tool to create value: improving cash systems real ROI. Private equity will optimize the portfolio allocation by reinvesting and reallocating, but it will also improve the real ROI of each one of its cash systems. Remember, private equity has 3 tools to create value: reinvest, reallocate, and improve the cash system's real ROI.